Hi, I'm Dave Brickell, Director of Sales at Paradigm. Welcome to The Big Picture.
Vol is reverting, so the obvious trade is always the expensive one to
this
carry.
whole peak inflation, peak rates narrative, peak Fed, which we've been talking about.
It's an expensive place to find out. Crypto vol, a potentially fatal place to find out.
The crypto option markets are definitely showing some signs of life.
Hi guys, welcome to The Big Picture. My name is Joe Cruey. I'm at Paradigm in the weeds around everything crypto vol markets. I'm joined here again by my colleague David Perkel, as well as Sohan Sen. And today we are joined by James from InvestDefy, a big structured product issuer in the crypto space. I think the timing of this episode is really good. Honestly, I don't know about you guys. I did not want to talk about range-bound spot markets or vols on the lowers again and realize being lower for another week. I just didn't want to do it. So I think this is an episode that is very good to help break up the pace a little bit, learn more about the structured product world of crypto, which I selfishly have a lot of interest because my past life in TradFi was doing a lot of these sort of things. And frankly, I'm still learning more about the products that are out there in crypto. And I think in this episode, you guys are going to learn a lot too. Before we begin, if you can just hit that subscribe and like button, really helps us as we continue to build the channel to the go-to source for insights around crypto derivatives. So James, if you could just begin by giving us a quick background for our viewers, like how did you get into crypto and ultimately how you ended up co-founding InvestDefy?
Yeah, thank you. I guess I got into crypto, I started looking at it seriously back in 2020. I was asked to evaluate a potential investment in a big data predictive analytics company in the space called InvestDefy, and that was at my predecessor company, where we were actually in the business of structuring product, predominantly FX to option-based structured product, as well as we were deploying a lot of capital, risk capital using ML and AI-based systematic models and model design. So this was a really interesting opportunity for me. I basically did our due diligence and we decided to make an investment in them. And then we quickly realized that we're looking at a potentially massive opportunity. I think the first thing that went through my mind was the fact that no one was paying attention to any sort of downside protection in the space. Everyone thought that returns were 1,000x. And
up only.
And I'm a 27-year TradFi executive, if you will, various trading roles. I said, this is a phenomenal opportunity for us to put together our technology, combine both entities, and come to market with a platform that we can actually monetize these gaps, if you will, because there was quite a few gaps. There still are quite a few gaps. And so we quickly organized. We did a capital raise in the fall of 2021. We've spent 2022 just building out our full stack platform, issue about 415 million in product last year. And 2023 for us is really about scaling and growing.
Awesome. Yeah, it's, super, super interesting. I feel like crypto structured products is something that's perhaps not really like fully understood within the crypto world yet. And I think it's natural that as the digital asset sector continues to evolve, we're going to see more and more instruments that, exist and are very popular in TradFi being adapted for crypto. And one such instrument, as I mentioned, is, structured products, which are investment products that are linked to underlying assets that typically use a derivative instrument to offer a return profile different from the underlying asset itself. And so these structured products typically can be tailored to the need of each investor. So they're an effective tool for achieving a variety of objectives, whether that is, the risk mitigation point that James mentioned, or return maximization, or, yield enhancement. And these are extremely popular products within the TradFi world. So it's natural as crypto emerges as its own asset class that we would start to see this increasing issuance. So I'm curious to hear about that evolution of structured products within the crypto space. Like, have you guys steadily seen more and more demand for this as institutions have entered the space? And, what strategies have been the most popular? Has it been the downside protection that you have mentioned, or has it been more, perhaps, on the yield enhancement side of things?
Yeah, great question. I think I'm going to come at this a little bit differently. I'm a bit of a cynic by nature. I've worked for some pretty large investment banks, worked for some pretty large buy-side organizations. It gave me a really good chance to look at both sides of the fence. And I know some of you here have had that same experience. Most of the structured product I see in the space is garbage. I think it's a bet against the house. And normally when the house is aggressively pushing something, that there's a reason for it. And, I think if there was a word that I would use to describe us, is authentic, right? I mean, when we look at designing something, we're looking at actually employing our own capital to it. So with that in mind, we've taken a different path, if you will, which is more around managed structured product, which is a bit of a newer concept. We're starting to see other providers actually coming to market with some of those, albeit I think that they're pretty gimmicky and a little light. But going back to your question, where's the interest? Definitely seeing interest in yield. And with a couple of sort of main requirements. One, reduce smart contract risk. Two, give me something better than the risk-free rate. And so it was a great opportunity for us to basically go to work and with the team, basically find a model that we feel works really well, that generates a very attractive targeted APY without sort of while meeting those two objectives, right? No smart contract risk and better than risk-free rate. And so we designed this model, we call it Stack, and our partners have basically been distributing it since the fall of last year. But it's effectively harvesting premiums in the option markets as best as we can. And the models are extremely defensive. They keep us out about half the trades of the year that we actually do try to trade, because we typically trade weekly. And there's a bunch of reasons why we chose weekly. We can get into it, but at the end of the day, it's been working extremely well. I mean, we're targeting upwards in the high teens if we do our job correctly. And so far, we've been spot on.
Right. Yeah, I think that makes sense. I mean, we've seen significant demand, and David works on it. And Sohan do a lot of prospecting for new customers on Paradigm, and it's certainly something that we've talked a lot about on the big picture, is the significant demand for harvesting vol risk premia within the crypto space, especially in Ethereum. As we discussed on last week's episode, in a post proof of stake world, especially after the Shanghai upgrade, like my ability now to be able to stake Ethereum for 4 to 5% APY, and then actually sell calls against that because I have the flexibility within my staked ETH. We're seeing more and more demand for that, and certainly in environments where implied realized differentials are fairly persistently positive. I mean, especially the past 2 months where spot has kind of just been shopping in this range, and sure, real implied is low, but realized is what I think like 7-day Ethereum realized is like a little bit above 30, right? You can see why these strategies are so popular. And something I saw on your guys' website that was super interesting to me is like how you guys are harnessing artificial intelligence and machine learning through your Dora AI to help guide some of your vol-based structured products. Like, can you explain how you are using AI to be able to navigate range-bound volatility markets, or last year elephant in the room, like the higher volatile black swan sort of moments that were quite common? Like, how do you work alongside your AI to be able to navigate the different vol regimes within crypto to just change so dramatically and so quickly?
Yeah, for sure. I mean, I think, first of all, I'm going to start off by saying that we're not chasing a hot narrative. I mean, as I mentioned at the beginning, we've been employing various predictive models to help augment our overall multi-factor model for, over 15 years. And, I think AI right now is pretty overhyped and pretty gimmicky. I think, anyone who tells you that they can give you a model that's going to predict price, that tell you is a liar, and it's a black bet. Doesn't matter what you say. So what we've been focusing on with regards to AI and machine learning is, where can we be informed? We're not looking for a final end state from our predictive models. What we are looking for is, what can we actually create that's going to help us inform? And if we're looking at a 1 week tenor as an example, what we've managed to do really well with our predictive models is predict absolute range in a week, right? So we have a pretty high hit rate. The way we define hit rate, that basically allows us to look at absolute range. We don't know if it's higher or lower. We do have some models that give us some guidance on directionality, but so that's number one. The second one is vol. We do a pretty good job at forecasting forward volatility, right? And so we have a 1 through 4 week term structure model that's quite active for us. Finally, what I'll say with regards to our predictive is we use our predictive to be overly defensive, not to be the opposite, which is highly offensive. And so what we've done is we've taken a couple of these different predictive models, we've merged them in with multi-factors that give us a very good success rate with regards to the overall structure of the strategy and what we're actually trying to control for. And so that's technically how we're doing it. I mean, I have a head of data science and a head of quant strategy and a team behind them that's basically constantly doing R&D. And it's a tough gig. Listen, I mean, it takes about 6 months to fully bake a really solid model. And out of that 6 months, you've probably gone down about 80 to 100 rabbit holes on potential models that, start to show a little bit of promise, but ended up getting, scrapped at the end. I mean, it's a really tireless sort of role and analysis. But one of the things I can tell you is that we've done a really good job at automating the entire life cycle of model design, all the way from feature design, feature analysis, because the firm at its core is really a data and analytics shop, right? We're taking this data and this analytics that we're developing to try to identify gaps in the marketplace, like I was saying, put a model together, or be contracted by our partners to actually control for a specific use case or a specific outcome if you want.
Right.
Yeah. So, I mean, could you go into a bit more detail about the range that comes out? So is my understanding right that the model would spit out and say it's going to move 2% maximum this week, and you don't know whether it's going to be to the upside or it's going to be to the downside, and then you come in and sell an option structure to take advantage of that range? Is that
so? Yeah, that's correct. I mean, what it does is it gives us a forward range target in percentage. And then basically what we're doing is we're constantly monitoring the error rate of that prediction. So, from our perspective, we want to keep that error rate as low as possible. But that model's retrained every week. That one in isolation as an example. And then to your point about how we actually come up with, what options we're going to trade, the model basically sets the risk. It says, number one, I don't like what's happening right now for the upcoming week, so do nothing. So we stand down, right? As I mentioned earlier. Second one is, based on all of the factors and the predictive analytics, here's where the model wants to set its strikes on the week. And then number three, it tells us whether or not it wants to sell strangle, sell calls, sell puts. So this is our yield model. We also have a market neutral sort of managed program on BTC that expresses a view using condors, right? So it's a little bit different. And in that case, it'll tell us whether or not it wants to get in a full condor or wants us to get in a call spread or put spread.
Right.
Does that imply, because you said
it's not really directional, just knowing that, the range. Does that not imply a level of directionality in terms of what the model's spilling out?
Yeah, I think, you're going to have a natural tendency to want to really explore that. I think you just, depending on how you behave, we've elected to just be disciplined on utilizing that model for a very specific reason. I mean, look, at the end of the day, if we had a really good high success rate and prediction directionality, that's an element that we would definitely love to pursue, right? But I'm just being honest. There's certain things that we can do really well, and there's certain things that we're still trying to do better.
Yeah, sure. James, are you able to share at all what some of the inputs are to that model? Or is that your secret sauce?
No, I mean, because I'm going to give you high level descriptions, but I mean, we're basically using range model. We're using an anomaly model that looks at a whole bunch of blockchain metrics. We're looking at a Z-score on the underlying. We're looking at a volatility screen factor. And then we're also looking at technical factors. So I won't get into which one specifically on that. But then what we do is we basically go through a pretty intensive monthly refresh on the models. And I think what you guys have talked about before, I've heard, and what you know of is there's regime shifts in this space, and it's a killer. So, your objective is to try to be at least with the curve. Maybe if you can, with a little bit of luck, you're going to be a little bit ahead of it. But we're constantly trying to evaluate the inputs of these models. What sort of inputs and factors and thresholds do we actually have to tweak in order to optimize, in order to give us, that ongoing high degree of success?
Right. I want to ask a question more about like the distribution into your end investors of these structured products, and for a little bit of background. So there was a good Anthony Pompliano podcast a couple weeks ago where they get into this existential question where is AI able to, eventually replace asset allocators altogether, or are we, still pretty far from this point? And they had on a guy named Jordi Visser, who is the CIO of Weiss Multistrat, where he mentioned that, leveraging AI is certainly helping with their investment process, but kind of like similar to you, at the end of the day, you kind of still need a human in the seat to be able to, inform and make those final decisions. And as we've mentioned, the crypto vol regimes are changing very quickly. But my question for you is, how do you sell an investment strategy to end users that relies on machine learning? Like, how do investors feel about placing trust in AI, and what sort of like reassurances do they need when you sell a signal-based strategy around like a machine learning model?
Yeah, that is the question. I'll answer it this way. I think from our perspective, we're leveraging the depth and expertise and experience of the team, number one. Number two, whenever I speak about AI, I talk about it in the context of augmenting. I don't talk about it being the focus, the nucleus of everything we do. It augments. Right. And I think that to your other, the gentleman you mentioned earlier, it's exactly that. It basically helps inform. I think number three, the other thing, that we talk to with our partners is that we actually promote human override. I mean, when you have an event, an idiosyncratic risk or an idiosyncratic event, I mean, a great example was the Russian-Ukraine conflict. Like, how can you expect your model to actually understand what that means and what that's going to look like for the market? So, we stood down for a couple of weeks just to see how the things are going to shake out. We also overrode the models on a few occasions, when there was so much dispersion around the FOMC interest rate meetings going back about 5-6 months ago. I mean, look, if we're talking about this particular strategy and harvesting premium, it's the last thing you want to do is, stand in front of a freight train and get run over some large event that has the opportunity for a huge spike in vol. So, those three qualities, right? Augment, depth of expertise in our management team and our team overall. That's our narrative.
Makes sense. So the last question that I had, and then we'll get into a little bit more of the macro stuff that David will speak to. But so on last week's The Big Picture, we discussed Galaxy's very publicized on-chain option trade that occurred on Avo, and I'd like to expand that discussion a little bit into this quote unquote on-chain structured product world. We know through the current offerings in DeFi, such as, the Ribbon, option vaults that we, as a plug, facilitate through Paradigm, on-chain structured products certainly democratize investment access that is normally not feasible for most retail, whether that's due to regulations or, a non-accredited investor status. And of course, I think we all agree that regs need to these innovations need to adapt, and in a way that doesn't stifle the growth, but at the same time protect investors from toxic products that I'll use a word that James used, that could potentially steamroll an investor with an asymmetric negative payoff. But beyond this sort of democratization of access, I feel like on-chain structured products have this significant advantage potentially in the future. I'm not saying now. I don't even know if there's demand for it now, but I used to work on a desk that issued structured products in the equity vol way. So in the equity vol world, so I'm very well aware how much of an immense pain in the ass that it can be, right? From managing settlements, subscriptions, redemptions, and additionally, there's certainly benefits around on-chain collateral management and reducing counterparty risk, and potential contagion situations like we had last year, where the default of one counterparty just triggers this chain reaction of defaults. So how do you see the world of structured products, and not only just in crypto, but even just more generally, evolving in the future to perhaps more of an on-chain world?
Yeah, there's a lot to unpack there. I think I'd break it down this way. I think, one of the reasons why I got into this space is for the technology, right? Not basically the hype. It was really the technology. And I've always been extremely curious about technology all throughout my career. And when I looked at, blockchain and technology of what can actually help accomplish on the settlement process and the actual workflows of a structured product, that becomes really exciting. There's no question. I think that the whole democratizing access and running everything through vaults is where, that's kind of the sexy narrative, in my opinion. To your point, it's not there. I mean, I keep looking at DeFi option vaults, and, I think if we were relegated to just trading there, it would be value destruction, to be quite succinct. There just isn't the depth. And I think that the market making community in this space, has some serious growing up to do. I think that spreads are just way too wide, and we're starting to see a few more thoughtful sort of market makers coming in, which is awesome. But I mean, it is a great world where, someone can connect their wallet to some particular site and actually invest in something that's a little bit more user interactive. And that, as an example, we've built the technology for a DeFi product platform that allows users to actually subscribe. It's in beta. We haven't gone live. And the sole reason is because we need a partner to go live with. There's just way too much regulatory here, simply stated. And the one thing I'll mention is that we don't face clients directly. We work with distribution partners. They're doing all the onboarding, the AML, KYC. We're basically providing the technology, providing the models, and we're providing the exposure for them on the underlying through a separate entity of ours that's acting as a liquidity provider and sort of market maker on behalf of the product, because at the end, they can be quite tricky.
How is it, James? How is it actually packaged and distributed to an investor?
Yeah, so there's a couple different ways. There's index product that are packaged up in an investment form called a contract. I guess it's akin to a certificate in the UK. And there's several reasons why we've elected to go that route. The yield programs that are being offered are structured as partnership units, so limited partnership units, out of a partnered issuer in the U.S. called Singapore.
Okay, interesting.
Mm.
And presumably institutionally focused.
Yes.
Yeah.
Our the whole go to market has to be the accredited investor space. Just, I mean, you're not going to get this over the line from a retail perspective. Zero chance. I mean, it's hard enough to get traditional structured product over the line for retail. I mean, the amount of KYC obligations imposed on broker dealers and, the gamut of sort of regulatory here is huge just on that right alone. And cryptos, it's tough.
Yeah, baby steps. Well, I think we all hope we'll certainly get there eventually. And, things certainly, in the U.S. are kind of going the opposite direction, but there's certainly, tailwinds in other areas, whether that's, in the Middle East or, big news out of Hong Kong or like, CCTV, talking about crypto on national television literally yesterday, right? So, that pendulum is starting to swing, a bit more towards the east. And, if the U.S. doesn't want it, then, the East will kind of take advantage of that opportunity. But, I think it's a good time to kind of segue into a little bit more of like a macro discussion. Let me just share my screen here.
Just while you're doing that, I wouldn't want to say one thing. I mean, I think one of the biggest issues plaguing, this segment is the element of trust, right? And at the end of it all, we talked about the very beginning of what we're trying to control for when we're coming up with these programs. One of the biggest ones, as I mentioned, was smart contract risk. So, the issuer effectively does not launch any of the collateral with any of the exchanges. It's all delegated. And, it was a decision made early on just for that fact. I mean, there's so much angst, if you will, moving collateral around, even on a DeFi option platform. I mean, there's no insurance, there's no nothing. And I think it's just like, you're asking me to take this leap of faith and just go and leave everything with you and hope that another FTX debacle doesn't unfold or, one of these other malaises, if you will. So that's where everything has been warehoused on the custodial platform, and it's worked well with us, and we've used that facility to trade with Paradigm, which has worked out extremely well. And I think trust is a big issue right now for more institutional adoption. That's for sure.
Oh yeah, absolutely. And I will even say, obviously the volumes, as we discussed, kind of fell off a cliff in the aftermath of FTX. We were at like peak fear in terms of leaving money on exchanges. And, certainly we saw a little bit of that institutional interest come back, as we had the spot rally. And quite frankly, we got lucky. Like if we were living in a world in January where we were just shopping range bound, kind of like we are now, then, the momentum could have really, really continued to be slow into the start of the year. But we still hear conversations like this all the time where it's just like, look, I mean, a lot of these exchanges, quite frankly, are, financial black boxes where like you have no ability to trust, with a high level of certainty or probability that your funds are going to be safe. And of course, the counter argument, go trade on CME. But I think the elephant in the room is that the CME margin requirements are pretty prohibitive, to be able to do things like that. So it's not always the easiest solution.
Well, they're prohibitive, and then the prime broker is basically putting a haircut on top of that as an addition.
Right. Exactly. Okay, awesome. Let me share my screen quickly. All right, David, your time to shine here. Like in terms of like the macro view, and this was an interesting chart that I saw on Crypto Banter, very popular crypto podcast. And one of the indicators that they like to really look at in terms of a long-term moving average is this 200-week, moving average. And you look at this chart, doesn't look great to me, dude. Right? So we're kind of like in this pretty nasty like head and shoulders pattern where we're right on top of like the 200-week moving average. And there's a pretty substantial gap to be filled here. If some of, these bearish sort of narratives do come to play, like the ones you've been talking around like the debt ceiling. So I'd be curious to kind of hear your view. Like, is there potential we do fill this gap lower? And if so, what are the drivers? Or do you think we potentially bounce off of this?
Yeah, I mean, I think I wrote in the Macro Pulse on the weekend, and we discussed a little bit last week about this negative dynamic that's been forming. Again, kind of, it's sort of very generic sort of framework that I look at in terms of what drives crypto and sort of rates, dollar, liquidity are three sort of massive parts of that framework. And all of those things at the moment are working against crypto. Now, obviously, at the heart of it is this debt ceiling drama and what's going on there. And you're seeing front end yields sort of spike pretty aggressively. You're starting to see the dollar sort of move higher. And, we've had that nice tailwind of the dollar sort of coming lower for a while, and we're seeing that reverse. And then there's the anticipation of this huge liquidity drain that's going to come assuming when the debt ceiling gets lifted. So within the Treasury's plans to sort of build back the general account, the Treasury general account, which is essentially their checking account at the Fed, they're looking to rebuild that up to 500 billion by the end of June, assuming we get the debt ceiling lift. So bear in mind, they're kind of running it down to zero at the moment. I forget where the latest number is. I think it's 70 odd billion. And they're spending, they're going through that like water at the moment. Potentially they're going to come and issue 500 billion within a few weeks. And that's just a suck of liquidity out of the market. And as we said before, like Bitcoin is a liquidity junkie.
So that line on the bottom is just going to continue moving lower, you think?
Yeah. So that line there, that's the global net liquidity. So obviously the US liquidity and largely driven by the Fed is a huge sort of part of global liquidity, certainly given the dollar's role in the global economy. But that global net liquidity there is looking at essentially Fed, PBOC, Bank of Japan, ECB, Bank of England. So it's kind of looking at a global liquidity measure. And there's offsets to what's going on in the US. You've got the PBOC, they've slowed down a little bit, but injecting liquidity. You've got the Bank of Japan still in QE mode. So their balance sheet's expanding. Obviously ECB are tightening, Fed are tightening. But actually what's quite interesting on the Fed side, you've actually seen an expansion of US dollar liquidity over the last few weeks, because to think of US liquidity, essentially it's a function of the Fed balance sheet. So obviously expanding, more liquidity, contracting, less liquidity. Right now that's in contraction mode because of this quantitative tightening. We actually saw around the blow up of SVB, and the banks, we actually saw that expand like 400 billion in the space of a couple of weeks. We're now back sort of giving some of that back and contracting on QT. However, there's offsets to that liquidity, and that comes in the form of the Treasury General Account, which I mentioned, as well as the Reserve Repo Facility at the Fed. So currently, the drawdown on the Treasury General Account, where the Fed, where the Treasury are basically using the cash they've already got at the Fed to sort of use and spend into the economy, that drawdown is outpacing the current sort of quantitative tightening. So dollar liquidity has actually been easing, which I kind of think why Bitcoin's still kind of being a little bit rangy and not doing too much. You can see on that chart, global liquidity is kind of rolling over. The concern when you get the debt ceiling lift is that you've got quantitative tightening alongside a rebuild of the Treasury General Account, which then actually is going to be working kind of alongside the QT, and you're going to have this huge tightening of liquidity, and you're going to see that line there on the bottom panel. You're going to see that start to sharply drop, and you can see like just even just eyeballing that, just the correlation in terms of directionally, as liquidity rolls over, then Bitcoin's going to roll over. So I think there's a pretty sort of concerning development on the liquidity front. I think we're starting to anticipate that. I actually think we're being held up a little bit by a broader risk. And, you know, it's like boomers have discovered AI all of a sudden and are kind of all...
Earnings were insane, right?
Yeah. I mean, there's good reasons to, you know, to kind of be bullish on, certainly on tech stocks and like the productivity gains that AI is going to bring. I mean, it's just funny to me that, you know, this has been around for a while and it's like all of a sudden the penny's dropped. So I kind of think actually the performance of the Nasdaq's probably kept us sort of pinned up. You started to see that everything looked like really shaky yesterday before you got those NVIDIA results come out. So yeah, I think we're in a really concerning dynamic right now. Everything I'm looking at that's been really positive and actually had us sort of bullish on crypto from end of November, early December, when we started to sort of say the bottom was in for this market. I still think the bottom's in terms of what we've seen over the past year. We're not going back to that. And I'm actually medium term pretty constructive for crypto because of this changing dynamic. I still think we're sort of peak rates, peak Fed, peak inflation, and that's going to be a supportive tailwind. But we're about to ride into a storm and a liquidity storm as that debt ceiling gets lifted and liquidity gets sucked out of our markets. And the other thing as well that's concerned me, so a big part of kind of, I guess, liquidity is the dollar. So a stronger dollar, we call it the dollar wrecking ball, that tends to sort of strangle assets and global growth. I say we're starting to see the dollar bounce. That chart there, you see that's Bitcoin against the DXY inverted. So actually, I mean, God, if you looked at that, it suggests we can go down to 23K in Bitcoin. So I kind of, see how see how that dynamic continues. What's worrying for me on that is I've been writing about China and the importance of China, and dollar China sort of starting to creep up. We broke through that psychological 7 level, and I think we hit new highs today above 708. The problem with that is the PBOC will look to smooth currency volatility, and they'll do it by selling dollar China, but then they'll recycle those dollars that they've sold to rebalance across their FX reserves. So which means buying dollars back against euro, sterling, Aussie, yen, and what have you. So it becomes like this constant, even though they're selling dollar China, they're then buying dollars across all the other currencies. So actually you kind of get this vicious circle, if you like, of sort of dollar buying that's coming out of China. And then you can see, that's typically negative for Bitcoin. So we've got a few things that I think look concerning at the moment. I think we're going to test lower. I actually think stocks as well will be sort of more challenged because I think they're fundamentally a liquidity play. So I think we're selling up for a tricky few weeks at least. Now there are some offsets.
Finger in the air. How low do we go? I mean, obviously the technical setup's not good. We know the debt ceiling thing is going to go to the 11th hour, right? That's given. But then most likely, they're obviously gonna push it through, and then you're gonna have all these treasuries come to market, which is going to drain the liquidity. Like how low can we potentially go here?
I mean, like 25K, right, is going to be like psychologically just we all kind of like roundish numbers, right? I think you'll test that, and then there'll be stops triggered through that. I mean, I still don't think positioning. We've seen volumes sort of decline hugely across exchanges, so I don't think positioning is particularly large to cause this huge, liquidity cascade and as we sort of trip levels, but certainly like momentum funds will jump on those moves. But I'd sort of look at 23K type levels. Now Now, again, this is all things equal. There are some offsets to that. You've got Hong Kong's about to come live on the 1st of June. And obviously we mentioned earlier about sort of sounds like China and is sort of pivoting more towards sort of crypto. So you've got a potential inflow sort of coming from Hong Kong, and then also it could well be that we sort of go into this, sell the rumor, buy the fact type thing on the anticipation of liquidity drain. There's also offsets as well. So if the Fed start issuing T-bills, we've got about $2 trillion that gets parked at the Fed every night in the RRP. That potentially gets teased out and starts to go and fund that. And actually then the net impact on liquidity is minimal. So there are sort of potential offsets. The other thing as well is I still feel, I still think we've got issues in the bank sector. PacWest selling off some of its loans, saw a nice bounce, but also it kind of speaks to the fact that they're still having problems. You're still seeing funds, deposits leave banks and sort of flow into money markets. So I still think we're going to have some issues in the banking sector. JP Morgan can't buy everyone. Well, Jamie Dimon's saying no. But maybe that's his opening gambit as he.
Yeah. So James, is David making you scared to sell vol here? What do you think? Like, do you think in terms of like your sort of like short term to medium term outlook in the space?
Yeah, I think it's a tough market right now to sell vol, right? I mean, we've seen a vol crush, and at least from my limited experience in this space, I would suggest that we're in uncharted waters right now in terms of where we are realized and implied. So, I mean, if you're a betting person, what are you going to bet, lower or higher vol? I mean, I think the money accrues to a spike in vol for sure. We were, just for context, I mean, Malls kept us out this week. And sometimes you just got to go with it, and it's going to end up probably being a very muted week in terms of range, but you're just not getting rewarded for the risk right now. So it doesn't make a ton of sense.
Yeah.
My main takeaway when I heard David talk just now was literally you should buy a 1 week put. I mean, I think that was my main takeaway, right? Because I mean that it's such a low cost, right? So it might as well.
Yeah. No, I mean, we spoke about that as well last week, right? On the podcast. It makes sense. Again, like timing these things is difficult. The other thing as well is like and certainly when I speak to clients, I think there's a huge lack of conviction out there at the moment. Generally, I think this uncertainty around the debt ceiling, people not sure how you play that. I sort of feel quite bearish, probably for the first time this year on crypto, just given these dynamics again.
I always thought David was a perma-bull.
Yeah.
I was like, Jesus Christ, this guy is literally always bullish. But now to hear that you actually are bearish is refreshing.
Yeah, I mean, well, no, this is very scary, right? I mean, my immediate reaction was, wait, David's bearish? Oh, I should go buy some put. Dean is saying to stay out of the market, don't sell vol. I'm like, oh, I definitely need to go buy some puts now.
Yeah, well, it's. I mean, we write the macro pulse, right, to kind of keep a literal sort of finger on the macro pulse of how things are developing, and all year those things have just been feeding beautifully, right? You've had dollar coming lower, sort of yields drifting lower, liquidity sort of improving. So again, like that's kind of how I look at the world. Risk trading pretty well, market under positioned. So I found it strange that, coming into the year, people were so bearish. When it's kind of, what framework do you use to sort of support that? But now look, when the facts change, I changed my opinions there. But yeah, so
I guess the big question now is was this whole thing just a bear market rally, or like we have that pullback and you are more medium term constructive? So.
Yeah. Look, I think these dynamics are short term. I mean, I'm super bullish, like medium term, like duration, like long duration. So like I think this is all in anticipation of like increased issuance and stuff like that, because actually the economic side of things, although inflation is not falling as fast as the Fed would like, it's certainly going that way. And in fact, actually, true-flation, which I like to look at, which is the sort of real-time on-chain measure of inflation, dropped below 3% this week for the first time. I think it went to like 2.98. So that. No, we've got other problems. We're battling our own problems, but but look, I think the Fed are winning that fight against inflation. In fact, I think I actually think that, well, I think they've overdone it. I think you're going to find inflation comes much more quickly lower than what people expect and what the Fed expects. People forget that monetary policy, the transmission of monetary policy, tends to act with like a 12-month lag, and we were barely into this hike cycle 12 months ago, and it was sharp and it was aggressive. So you're going to start to see that feed through pretty abruptly, I guess, over the next few months. And then on top of that, you've had this banking crisis and the implied sort of credit crunch, which is coming, and we're seeing that, which is hugely disinflationary. So I do think the Fed will be back into easing mode probably by year end, and actually things will look sort of quite different. So that kind of dynamic is a completely different macro environment to what we had to endure last year. Inflation. Last year we had inflation at double digits. You had the Fed pursuing the sharpest tightening cycle arguably in history. Now we're kind of reaching the pause. I do think cuts will follow. I think the Feds still want the optionality for their credibility to maybe hike, but I don't think we're seeing any more hikes. So we've got an easier rate environment. Inflation's coming lower. So yeah, I still think we're going to finish the year significantly higher, and maybe as well, you know how these things work. Maybe this is like the kind of final shakeout and dip before we then really sort of power through and take out those highs around 31, 32K, and then we have a really good run into year end.
Yeah, awesome. Well, I think that's on those positive notes, this is a good place to kind of end it.
Yeah, I'm out.
A little bit depressed earlier, but
yeah, I'm out tonight, Jay, with some crypto people. So I don't want them not buying me drinks.
Well, we learned a ton on the structured product side of the crypto markets, and kind of your daily process in terms of getting people to invest in crypto structured notes, and the growth trajectory of this space. So thank you so much for coming on. Really learned a lot.
Yeah, my pleasure. Always happy to connect with you guys. Love what you guys are doing.
Awesome. Thank you, James.
Yeah, thanks, James. Thank you.